Hi, we're moving right along. We are on session number 4. And in this session, we're going to cover some important assets. In Module 6, we're going to look at primarily inventory and property, plant, and equipment. And in Module 9, look at intercorporate investments, which is buying percentage ownership in another company. So let's start with Chapter 6. And the comic strip is apropos because next week is Halloween. So we see two witches saying, I remember when tea leaves were the state-of-the-art method of determining your inventory needs. Well, this is a bit of a comic, but it's really not so funny because companies have an important task of inventory management. If inventory level's too high, they tie up too much cash and the inventory has a risk of obsolescence. If they have too little, they may sell out. And in that case, a customer comes, doesn't have a product. Not only do you lose that sale at that moment, or you may lose the customer. So these are important management decisions on how to manage assets and other property, plant, and equipment investments. Learning objectives for this mod. One is to look at inventory costing methods. You may have heard of FIFO and LIFO, where we're going to learn it here. Then we're going to look at how do we analyze inventory and the related side of accounts payable. Third, look at tangible assets, specifically property, plant, and equipment, or PP&E. And focus on how it is allocated over time via the method of depreciation. Fourth, we'll look at asset sales when we dispose of a piece of equipment, or impairments when an asset goes down in value, and finally, restructurings and what happens in those cases. And fifth, looking at analysis of tangible assets, again focusing on PP&E. So we've seen the cash conversion cycle before, but now we're going to go in a little deeper. So let's review it and look at how the accounts that we're going to see here are affected. First, we buy inventory on the left-hand side. And at that entry, inventory goes up, that's an asset, and accounts payable entry. Both sides go up. Assets up, liabilities up. Specific accounts, inventory, and accounts payable. Second is we sell the inventory. That is broken into two pieces. The first is the sale transaction. We'll look at accounts receivable going up. That's an asset because somebody owes us money. And we also show that our revenues are up, which is an income statement item, net income. So that will cause an increase in net income and increase in retained earnings. The second part of that is inventory went down because the sale involved some inventory going to the customer. Inventory goes down, that's an asset, and the cost of goods sold, which is offsetting the revenue, has an increase, and that's a negative. So it's a negative because it will reduce our profit because we gave up some inventory to accomplish the sale. Those are the entries required for the second stage, was the sale to a customer. Third is we're going to collect our accounts receivable. The customer will pay us money, so cash goes up and they owe us less money because they paid us. So receivables go down. We saw that in last mod, in mod 5 on revenues and receivables. And fourth is we pay vendors. We have cash go down and we also show liabilities go down because we paid them what we owe them. So that's the cash conversion cycle and how it definitely involves a lot of inventory action. So let's look at inventory. There's broadly two kinds of inventory. There's inventory that you buy that's ready to sell, and that's like a merchandiser. When you go to, say, Macy's, the shirts and the things they have there are usually purchased from another vendor who makes them and sells them to Macy's. So that's an example of a merchandiser. The other side is an example of a manufacturer. A manufacturer creates the product. They buy raw materials, they have direct labor to work in the factories, and they have overhead for running those factories. And those costs combined reflected in the cost of the items and in their inventory for making the product that they produce. Cost of goods sold is through what looks a little complicated in terms of inventory. When I think of something like inventory, I think of like a showroom with shelves. And let's use that analogy and go through these steps. So on the very top, we have beginning inventory. So we start the year, we have some inventory sitting on the shelves. Then we add inventory. We buy more things for sale from, say, our suppliers. So those two are added together to form what we call cost of goods sold available for sale. So it's in inventory, but all of those are available for sale. Next is we have the ending inventory. Let's say at the end of the year, we go through, we count what's left on the shelves, and that in combination of cost of goods sold has to explain all the goods available for sale. Because it was on the shelf at one point. It has to go to one place. It's either still here or it was sold. Bottom reflects one of the ways that we compute cost of goods sold. Frankly, it's a very simplistic way, but it gets us started. So beginning inventory plus inventory purchase equals the cost of goods available for sale. If we subtract the ending inventory, the leftover amount has to be the cost of goods sold. And so those go to the income statement. Let's try it with some numbers. Let's say we start the year with 100 and we purchase 500. So the sum of those two is 600. Then we go and count the inventory and we say we have $200 left on the shelves. 600 minus 200 is 400. Now we can explain what happened to the goods. 200 is still here, 400 is cost of goods sold, and that will go to the income. That was a very simplistic view, but it almost is too simple because when we buy inventory, it's all at different prices. What do we count? Which ones do we sell? Because each one has a different cost. And this falls into the area of cost flow assumption. And they're named things like FIFO and LIFO. So you may have heard those before, and now we're going to jump in and you can learn how to do those calculations. What we will look at for FIFO is first in, first out. And imagine you are Safeway and you're selling bread. Well, you would hope that customers will buy the first bread that you got, because otherwise that bread will become stale over a few days when people keep picking over the stack of bread available and only buys the freshest bread. Retailers love to sell FIFO, so they constantly do what we call rotate stock. LIFO is the opposite. It means the last in is what you sell. And LIFO, under LIFO method, the cost tends to be a little higher because cost rises over time in general, and so LIFO yields some higher cost items. And average cost is where we say, well, I don't know specifically, but I'm going to use the average cost for all the items we purchased this year, and that way the same cost per unit is used in inventory and the same cost per unit is used for cost of goods sold. And we'll do examples illustrating all three of these. Here's the assumption. We have beginning inventory of 500 units that we bought for $100 each, so it would cost us $50,000. The purchases this year are 200 units at $150, and so that's another $30,000 a year. So the available for sale is 700 at some blend between 100 and 150. We won't do that at this moment. And the total cost is $80,000. And furthermore, we sold during the year 450 units at $250 per unit. The question is, what is the cost of goods sold and what is the gross profit under FIFO, LIFO, and average costs? Let's hop into Excel and see how this works. Here's the same data presented on the left, and we're just going to do one at a time. So let's start with FIFO. Now remember, FIFO means first in, first out. In this scenario here, we sold 450 units. We have how many units of 450? And notice here that if it's FIFO, this entire, what we call layer, has more than 450. So we could say that 450 was from this beginning layer, and this cost was 100. So the cost was that times that. The cost of goods sold is $45,000. Gross profit, so we start with revenues. So revenues under this scenario is equal to 450 times 250 per unit. That's 11,500. Let's just format the same. And our cost of goods sold under this scenario, I'll use minus 95. And our gross profit is that minus that. So we made $67,000. That's FIFO. So this is our first scenario right here, and we'll do the other ones. All right. Next, let's do LIFO. So LIFO, how many units did we sell? Still 450. But look, we have a problem here. The 450 starts with the last in, so that's 200. But we're still short, right? We still need another 250. So we have to go back to the next latest level, and that is this one. So we sold 450, 200, we sold out this layer, and the 250 we got from the beginning. And so again, we take just copy this. So now our cost of goods sold is $55,000. Notice that this number is different from this number. And the reason it's different is In the first case, we took all the cheap ones, right? We took the first ones. In LIFO, we took the expensive ones plus some of the lesser expensive ones. Let's also do the same thing on revenues. The revenues, it's still the same price. We still sold them for $250 each to a customer. And our cost of goods sold now will be this number. And so we have a lower gross profit. Again, lower gross profit occurs because our cost of goods sold is higher, which drives down our profit. So the next one is average cost per unit. Now under average, I'm going to go back here and take the average right here. I'm going to take average. And average is a simple number. It's how much did you pay overall? 80. How many did you buy? 700. So the number is 214. Now, when we say under this method, we say it's still 450. We still say it's the same amount. And our cost we're going to use is the average. The cost is 450 times the average. And so this is our new total. And we can then do the same on cost of goods sold and margin. And what do we see? 45 was the lowest and 55 was the highest, and average, as average means, is in the middle. Our revenues are the same, doesn't matter. These are identical. Just highlight that in blue, so these are exactly the same. So where's the action, right? It happens right here. Cost of goods sold is what varies by cost flow assumption. Therefore, the profits are different. It's the highest profit if we use FIFO, the lowest profit if we use LIFO, and kind of in the middle if we use average. That is LIFO, FIFO. What we observe is sales were the same. That's 112,500 right there. And then the cost of goods sold 45, 55, 51. 45, 55, 51. And our gross profit is the highest under FIFO, lowest under LIFO, and then the middle for average. Okay? So that's what we do. That's all there is to FIFO and LIFO. Next we say, well, how will we do some analysis of the financial statement effect? Here we have an example of Caterpillar, which makes Caterpillar tractors. They had LIFO method as their selected method. If they valued those inventory at FIFO instead, they would have made an extra $2.5 billion. That means that by adopting LIFO, since in general costs rise, they charge more money to their expenses because it's LIFO. So they're being conservative. Conservative in this case meaning showing less profit. If you're an investor in Caterpillar, you'd like them to show a lot of profit, but you're actually okay with them showing less profit because guess what? Lower profit means lower income taxes. The cash flow effects from LIFO, FIFO, they would actually save some money on the taxes, but their balance sheet would show a different inventory level. It would show lower inventory. And their COGS would be higher because they're taking their more expensive items and charging it to expense. They save taxes. Their cash flow is higher because they were able to save money from taxes, right? Which is a motivator. If we were a private company, chances are we would always use LIFO.